There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice, brought to you by TackleTrading.com.
Welcome out to the Trading Justice Podcast presented by Tackle Trading. This is one of your co-hosts, Matt Justice, along with my amazing trading partner and co-host, Tim Justice, bringing you the podcast for the week of June 16th, 2015. We got a lot to cover here today, but before we do, want to go ahead and introduce our amazing special guest, because, Tyler, that's how we introduce every one of our guests, amazing and special, all in the same light. Tyler Craig. Tyler, how are you today?
Doing good, Matt. Thanks for having me on board today.
Oh, anytime. Tyler, I've known you for a better part of a decade now. I remember coming into old Teach Me to Trade, WIA, before it was Rich Dad, right? And that's kind of how we met, was through the coaching program way back when. And I don't believe you've aged one day since that day I first met you. I'm very jealous of that, by the way.
I take vitamins.
He's living healthy.
Yeah, maybe that was an indictment of our lifestyle, Tim. I think it was an indictment
that's
of
more
our lifestyle.
to say about us than him, but yeah, I'm sure Tyler.
I'll share my diet plan with you guys. Don't you worry.
Well, that's why we brought you on the podcast. It has nothing to do with trading. I mean, we just want to understand what's your secret, buddy. So, Tyler, You've been trading. When did you start trading?
Well, when I started with my dad's money. He let me open up an account at Options Express and dink around.
How old?
Probably 18.
18? That's what I thought.
Mm-hmm.
Yeah, I knew
19
Rob
maybe.
really well. 18, 19 years old, and what your dad was obviously trading. He'd been investing for a long time. What got you interested into it, though?
So when I started in high school, my dad was he did real estate, and I was what you call free labor. So we did rehabs, and I'd have to help him, tear down the houses, build them up. And in high school, not a big fan of hard labor, shall we say. And so we attended a conference in Florida, and they were marketing Teach Me to Trade, software, trading, etc. Mm-hmm. And I said, "Hey, look, Dad, you want to be an investor? Great, but how's about we try out some trading so I don't have to swing a hammer every day?"
Yeah.
And so from there, we took classes, and he kind of let me tag along with him. That was my initial exposure.
Tim, that reminds me of our journey a little bit, growing up swinging hammers and putting on trusses and building houses and, the manual labor aspect. But you brought me back a little bit. I remember the first time I was introduced to the Teach Me to Trade trading software. It was, I don't know if you guys remember, it's called, you had the Trade Center, and then you had the Trade Seeker. And this is back in 05, 06, where basically you had, what I felt at the time, it was a pretty solid little software, in terms of using the Seeker to find some potential trades. I thought their charting software was pretty decent. Really weak on options, I would say, in terms of the Trade Center, Trade Seeker. But I enjoyed using that for a couple of years.
Mm-hmm.
Yeah, I think initially when you first get exposed to the world of trading and software, it's like magic, because you don't have any context. It's the first time you've ever been exposed to it. Yep. I thought it was awesome.
Yeah, I really liked it. In fact, I remember when it was when I came into Rich Dad, and I was negotiating a new contract with them to continue using their software. And negotiations were ongoing and lengthy, and we kept going back and forth. And I remember John Kane. I don't know if you guys remember John. He was the VP of Whitney Information Network, who ultimately became Tigrant, who ultimately became Rich Dad Education, then who ultimately became Legacy. My goodness, what a journey that was. But he says, well, what do you think about creating a new software? And I said, well, I've never done that. He says, well, why don't you put some feelers out there? And that's when I met Tom Joseph through Jeff. and started talking to Tom Joseph, and that ultimately became literally, Ty, I don't know if you know this, but I literally for a month I wrote the original spec for the software EduTrader before it became known as Mock Trader. And so I wrote these 4 different levels of the specs, had no clue what I was doing, trying to get help where I wanted to get help, but Tom was just so awesome about it. Programmed what I consider really, really, really solid software in EduTrader, Mock Trader. But even ultimately that became a little dated. And I want you to speak to what the brokers are doing from a software perspective, because I just think brokers like Thinkorswim and Interactive Brokers and TradeStation and even some of the consumer brokers out there, they're doing a lot better today than they historically have with trading softwares. What trading software do you currently use right now? I think everyone.
So I use Thinkorswim.
What is it about Thinkorswim in your estimation? If you're talking to 500 new traders, because that's about who you're talking to right now, if you're talking to about 500 new traders who are very new to the market, what would you say about Thinkorswim sets them apart that other brokers don't have?
So I'll back up a step. So my path with brokers, I started with Options Express because that was the first one I had heard of. So I started with them, and their commission. Hang on, my computer's going to sleep here. Can you guys still hear me? All right. So their commission was pretty high, and so the second broker I tried out was Interactive Brokers because they're well known for pretty much being the cheapest broker out there. Traded with them for a while, and then Thinkorswim has, in large part, superior tools and features. And I was able to get them to get close to matching Interactive Brokers' commission. So I said, well, if I don't have to sacrifice much on the commission side and I get all the tools, why not just use one broker? And that's when I moved to Thinkorswim, which was years ago. So why you use them, for a lot of new traders, one of the, particularly those that aren't tech savvy, I think one of the biggest hurdles is getting comfortable placing trades, getting comfortable with all the gizmos and gadgets that are offered by brokers.
Orders, whatnot.
And if you're going to go through the hassle of learning one, why not just start with the best? As opposed to trying to have an evolution of, let's start with somebody basic and then go intermediate, then go advanced. I say just plunge right in, go with who, in my estimation, and in most people's estimation, is kind of cream of the crop, and just jump with toss.
So coming back to Thinkorswim, Ty, I absolutely agree with you 100%. I think they are the best broker out there, and we don't even get anything from saying that. We like our students, we like our clients to use the best. From an order entry standpoint, I think they're stellar. I think that their commissions are negotiable to very fair rates. You can trade any instrument over there that you want, whether it's commodities, currencies, options, or stock. And I also think one of the things that they do really, really good that some brokers don't necessarily do as well is portfolio management tools. On their monitor tab, having the ability to break down the strategies, having it calculate your delta and your theta and your option groups from an option trader is very important as well. And then custom order entries, a right-click sell iron condor. I mean, you can't do that with a lot of other brokers. So I think they're fairly. I think it's fairly apparent that they're the best options related broker out there, and you might as well learn from the best. I absolutely agree with that. Now, coming back to kind of your trading, when you first started trading, what primarily did you trade?
I started with stock. Mm-hmm.
Stock? Okay. Do you remember your first stock you traded?
Oh man, I can't remember what I had for breakfast this morning. No, I couldn't tell you the first stock that I bought. I remember Red Hat. Was one I traded. Yeah.
Red Hat?
Phelps Dodge. Phelps Dodge was another. They got bought by some other company. I forget who. But those are just two tickers that come to mind.
A couple of my first ones, I remember First Solar, trading First Solar a lot. I remember trading Schlumberger a lot. I remember that, Ty, because I remember always calling it Schlumberger until somebody, I can't remember who, but somebody come up and says, Matt, that's not their name. I'm like, I'm just a hick from Huntington, Utah. That's their name to me.
Sure.
You always remember those first couple that you kind of kicked your career off with. So you first started trading stock and whatnot. What got you into options trading?
I think initially that was just the next step in the evolution of learning how to trade. To be honest, I kind of learned the ropes with buying stocks, shorting stocks, and wanted to continue. And I think for most people, that's an easy one to kind of transition into. So, and they excite me. I like things that are kind of complex. I like to gratify my ego a little bit and try to embrace things that seem difficult. And so I think I initially was attracted to that as well.
It's good to hear you admit that. I like to gratify my own ego. I like that. That's a good one.
Just being honest, man. I got an ego.
I like it. Everybody does. You might as well just admit it. That's how I've always seen it. You know, in terms of the evolution of a stock to an option trader, so I was out in Tacoma, Washington this past weekend. I was teaching a group of students. Half of them were from Rich Dad, half of them were from the IBD and whatnot. And the IBD crowd, the Investor Business Data crowd, they've been trading stock for a very long time. One thing that they haven't done is evolve into the options market because they've had success trading the IBD top 50. They've had some success trading the cut list over there at IBD and whatnot, but they haven't had any success trading options because IBD doesn't do it. Well, in terms of that, the one thing I kept coming back to them was like, guys, if you're trading stock, it is a natural progression to trade the option. If you're going to buy a stock, you know, in this marketplace, Tyler, people who are just buying stock aren't making any money. Some of their stocks are going up, some of them are going down, and some of them are flat out neutral because the market over the last, 8 months is basically break even, and so a lot of their stock trades are basically break even. So I said, if you want to make money in a neutral market, if you want to make money in a bear market, if you want to enhance what you're already doing, then you have to trade the option. And what I was kind of getting at initially was just the covered call. And you teach a class right now for Legacy Education called it used to be called Cash Flow Options. I believe we officially changed that name to Options 1 yet? I think we have, right? Okay. Okay, so we have Options 1,
same with Options 2.
And so you teach a class over there called Options 1. It's the first class that our students who are trading options go to. So they'll go to Master Trader, then they'll go to Options 1. And in that class, it's primarily, obviously, an options class, since that's the name. But one of the first strategies you teach them is the covered call. And I want to talk to people out there because we have a lot of people listening who are trading just stock right now, Tyler. And some have found success, others have not found success. Talk to them about what the covered call strategy is.
So the analogy we like to use that I think most people can relate to is that of renting out your house. So suppose you buy a house, and the only way you can make money is if the house goes up in value. So you have your own house that you live in, and you want to go buy a residential property to invest in real estate. And suppose I said, look, you can't rent out that house. The only thing you can do is go buy that second home or that investment property and sit on it for a year or 2 years or 3 years or whatever. You'd probably come back at me and say, hey, Tyler, I'm fighting with one hand tied behind my back because you're not allowing me to rent out that house. I mean, I own the house. I already bought it. Why not throw renters in there so I can generate a little bit of cash flow along the way? It seems like I'm handicapping myself here. And that's effectively what you do when you buy a stock and don't ever consider selling covered calls. The stock is kind of like the house. If it goes up in value, you make money, and most houses do over a long period of time. Some stocks do over a long period of time. What do you do in the meantime, right? What do you do if the house values are stagnant or they're dropping? Well, you find comfort in the fact that you can rent it out and generate some income in the meantime. That's effectively what you can do with a covered call.
It's a great strategy, and that analogy is rock solid because, I mean, when you think about it, nobody in their right mind would ever just go buy a property and just sit on it. Nobody would do that. That's not what you do in real estate. You go buy a property and you basically, name of the game, cash flow monthly. Well, to do that, you have to find a renter, you have to find a tenant, which basically means you have to take out marketing and whatnot, find a tenant, you rent it out. So you buy a $100,000 property. You have we'll just say $1,000 loan just to make the math easy. You rent it out for $1,500. You're positive $500 cash flow. And you ask everybody out there, and they're like, yeah, that's a good agreement. That's a great agreement. And then you ask them, even take it a step further, Tyler, you say, okay, well, in the next recession, what's going to happen to the price of houses? Well, they're going to go down. They might not go down like they did in the subprime market crash, but they're going to go down. Well, are you automatically just going to go dump all your property? No, you're going to offset risk by renting it out. And during times of recession, you can actually rent them out for even higher than you can during the boom economic times. And everybody's like, yeah, that's a great agreement. And I always ask people this when I'm teaching the covered call at a 3-day training. Is that a good strategy? Everybody's like, yes, fantastic. Okay, do you offset risk? Absolutely, 100%. Well, what's the only problem with that scenario? The only problem, it's not depreciation. The only problem is tenants. Sometimes they mess up the joints. Sometimes they don't pay. Sometimes tenants are just dirty, rotten, filthy human beings, right? And yet sometimes the power goes out, or you have to go fix the roof, or whatever the case might be. Well, what if you could substitute the house, the property, what if you could substitute for a stock? And from our mindset, Tyler, when you actually start learning how to trade options, you would never just go park your money in a stock for the same reason you would never go park your money in a real estate agreement. You have to get it rented out. And the way we rent out the stock is we sell a call option against it. We give somebody else the right on a monthly basis to buy our stock if the stock goes up. And I had a student, and when you start understanding it like that, people start getting it. They start understanding the mindset. I got an email from one of my students today, and her name's Rena. Love her. She's out of Washington D.C. Been working with her for a year now. And Rena basically sends me an email today. She goes, Matt, I'm down 20% in Southwest over the last 6 months. I said, well, yeah, Southwest has went down. So has every one of the airline companies the last 6 months. And she goes, well, should I just dump the stock? What's going on? I said, well, Rena, have you been renting it out? And she says, yes. I said, have you rented it out every month? She says, yes. I said, Rena, well then, what was your average return on the renting it out? She says, about 3% monthly. I said, so you've been renting it out for 3% monthly over the last 6 months. You're effectively gained 18% on the rental agreement. You've lost 20% on the property value, which means you're only down 2%. That's not that bad of an investment, especially when you take into account that paid you a dividend over the last 6 months as well. And that's how you can offset the risk of it. It's an absolute wonderful transaction. And Tyler, from a difficulty perspective, would you say this is a difficult trade?
No, I mean, matter of fact, it has the nickname. It's the gateway strategy into the options market, because one part of the trade you're already used to doing, and that's buying the stock. And the only thing in addition you have to do is sell a call, and you're done.
It's a click of a button, isn't it? I mean, you click the button, you're done. It takes 3 minutes a month. You obviously want to manage it, but it's a really, really simple strategy, and it's one that everybody out there needs to be doing. If you're going to buy a stock, if you're going to buy a property, you're going to rent it out, you're going to find a tenant, we're doing the exact same thing. And what people in the market don't understand is that whatever they can do in real estate, and that's good. Real estate's fantastic. I love real estate. Whatever you can do in real estate, you can do with the click of a button in stock. That's the truth. In terms of wholesaling versus
I'm back, by the way.
Good to have you back here, T. We've been talking covered calls. And
the conversation can begin now.
Yes, we can begin the podcast. Tim Justice is back. Everything is right in the world. Thank you very much for that. By the way, Tyler did say he was coaxing his ego a little bit. Fully admitted that he has a very big ego, but I do not believe it's as big as yours.
I actually don't have ego.
Whatever.
I killed it long ago through meditation, good healthy living. And
First of all, I don't even think you would know how to meditate. Don't start. Don't start. I don't even think you would know how to.
Ask your road manager, Bo, about how I explain meditation to Sandy on the road.
I'll have to talk to Bo about that, because Bo does meditate. He does the whole.
It made him laugh. Now I made him roll laughing. So ask him about it. He'll know exactly what I'm talking about.
I'm in Boston this week, so I'll be on the plane tomorrow, watching him get upgraded and me sitting from the cheap seats in the back. So I'll definitely get around that.
I want to jump in here for a second, though. You're talking covered calls, right? Okay, one of my favorite strategies. Tyler is a cash flow king. I don't know if you guys know this out there. I mean, Tyler, I got to tell you, I think you're a very patient instructor, which I appreciate. I like it. I always get a lot of good feedback from your students. You and I have almost an identical path in trading. I was listening to you talk about your brokers. Actually, I started with Options Express, moved to Interactive Brokers, then to Thinkorswim. Right when I got cut off, I was going to say something about Thinkorswim. I want to get your take on it. Going back on this, I don't think they've made enough updates for how much money that company makes in the last 5 years.
That's not Thinkorswim.
That software hasn't changed much in 5 years.
That is not Thinkorswim. That's all TD Ameritrade nonsense and BS. And it goes to show you how good Thinkorswim is, since they haven't made that many updates in 3 years, and they're still the best options broker out there. So I separate it.
So Tim, what I would ask is, what do they not have that you want?
Great question.
Well, they have everything I need personally, but I think backtesting options a little bit better. Their on-demand tools, which I think are great, they're so slow at loading data. I don't know what the problem is there. I don't think they've put a lot of time into that. Or money into fixing some of that. I mean, there are a few little things.
The speed
having just some
the
of the
speed of the on-demand could be improved dramatically. In fact, we use it to backtest, but I cannot bring that up in front of a room. I don't trust the speed of the data to actually show it to people. So that I do agree the speed of the on-demand could get a lot better, but I think that Tyler asked the right question. From an actual trading application perspective, I mean, honestly, what else do we want? What else would we want? Maybe better drawing tools?
Well, I agree with the charts. My only quibble with them is their price charts aren't so hot. But all the options analytics stuff, I'm cool with on my end. So
charting could get better. They're not the best charting.
I think that the other thing is, like, the volatility analysis inside the risk graphs isn't necessarily reflective of the individual strikes all the time. I think it leads to some misleading stuff. I think they could change that. There's little things. I can send them an email. I'm sure they would answer it and fix them right away.
I'm just curious.
Little things I'd like to see. Yeah, but they're pretty strong. I like them. I mean, the thing about software is, quite frankly, a lot of traders don't really need a lot of advanced tools. It depends on your system. If
you're just doing covered calls and naked puts, long stock, and some basic cash flow strategies, you don't need a lot of tools and bells and whistles to be really good. I do think their apps could get better, though. I think their apps, their iOS apps, could get better.
Oh, the mobile app.
I think online.
I don't really.
Well, you don't have to use it as much as I do, because I'm on the go a lot, and so I've had to place trades from 38,000 feet in the air before, and it's not the easiest to do what you need to do from an order entry standpoint. If you're just getting out of a trade, easy, but they could do better from an app standpoint, definitely.
I wanted to ask Tyler some questions today, Matt. I was doing a lab this morning, and I asked my group, what do you want me to ask Tyler? And I got a list of 4 or 5 of them here. If we got time for it, I want to get into it at some point.
Right now, go.
Well, let me pull out the old notebook. First one, Tyler.
You pull out the notebook. I'm going to do a drop. You've been listening to the Trading Justice podcast presented by Tackle Trading. If you like the podcast, you enjoy what we bring on a weekly basis, if it helps you stay on top of the markets, take a moment or two. Go over there to iTunes, leave us a nice little 5-star review. And if you don't like the podcast, you shouldn't be listening to it in the first place. Go ahead, Tim.
Yeah, I have a couple of questions on my own, then I'll get into the student questions. One thing, Tyler, you're a blogger and you're a writer. And having done some writing myself in the past, maybe not the volume you do, because you do it quite often for Rich Dad Education, and you've done it for a very, very long time, and you're very good at it. How long did it take you to get to a point where your process was very efficient and dialed in?
My process of writing, being able to hammer out content in a shorter period of time, you mean?
Yeah.
Oh, you lead with a hard question here, Tim.
What do you do here, Tyler?
I don't know. So when I started a blog. This is back when they had Blogspot, and that was like I think the first blog I started. And I just more so. Here's my motivation, Tim. Here's my motivation. I like the phrase, "If he can do it, why can't I?" Okay, That guy can do it. Why can't I? And that motivates me a lot. And so with writing, it's like, all right, I can explain something, and so what I like to do as I read and as I digest content elsewhere, is like I get enjoyment out of trying to figure out better ways of saying something. It's specifically because we're in the training and education business, conveying concepts in an easier to understand manner. Like I get excited about that, coming up with a new way of phrasing something, or just distributing and delivering the information in just a clear, concise manner. And I really get excited about that. So I extract a lot of enjoyment when I get done with an article saying, nailed it, bam, said it in about the best way I think it could be said. And then, just obviously that's expended over time. So to answer your question, I don't know.
It's taken a long time.
At some point, I just kept doing it, and then it becomes a little easier. And some topics are harder than others, like throwing out a trade idea and coming up with 400, 500 words of explaining the trade. Like I've done that a gajillion times, and so like in my head, I kind of know the template and the flow. Now, if you were to have me write about something I've never written about before, like give me a summary on the Fed minutes. Well, give me 8 hours because I don't know how to do that. And so I think it's just.
What are you talking about? You go to federalreserve.org, you copy paste. That's the summary. 500 words. Done. That was easy.
Okay, I'll try that next time.
I do want to say something you said though, because I think it's an important distinction. I've known, and we all have known, some awesome traders that were also not awesome teachers of how to trade. What do you think separates somebody from the ability to go out there and trade versus the ability to go out there and teach others how to trade? IQ. That's no. End with that. That means all of us are geniuses. I'm good with that. Done. There's the ego again, Tyler. There's the ego.
It's cropping up.
Yeah, I'll throw my 2 cents in on that, Matt. I think really one of it is the ability to step outside yourself and see the world from somebody else's perspective. I think to be a good teacher, you kind of have to do that. And when you can have a room full of people, and you know this, Matt, because you've been teaching long enough, and Tyler, you know this as well, they're all going to have different learning styles. They are unique.
Very much so.
And you have to have the ability to recognize that in a way and also deliver content at a pace and in a way to where they can absorb it, And Tyler, I've noticed over the years you do a very good job of thoroughly taking notes. You're a very patient teacher. I think you explain things really well, and I think you hit a lot of those learning styles. The only thing I would say maybe is you could be a little bit funnier. You could
work on the humor. Work on the humor. There we go. That's Tyler. That's what people really, really pay us to do, is to make them laugh. That's why we are educators. But Tim, no, I agree with your learning styles. I think that's the number one factor, to be perfectly honest with you. I think people who are just great traders and just that's all they do, and they can't teach others how to trade, they're so inundated with themselves that they don't understand there's others out there that do not learn in their same capacity. For example, you have the drivers out there who are so inundated with them and their process, and it's all about them, that they don't care about anybody else. They just want you just to fixate and focus on them. And then you have the heart mentality and the club mentality, where they're fixated more on the stories of others and the experiences of others and learning through those experiences of others. One of the most challenging things to do is when you got a room full of half of them drivers and half of them, clubbers, where they basically learn vastly different. And I had that experience this past week, and I was talking to Tyler about the IBD group versus the Rich Dad group. Very different mindsets in terms of how they learn anything. And it's challenging because if you don't capture the driver mentality initially, they're done with you. It doesn't matter what you say to them; they're just done with you. They're not. It doesn't matter if you make them $1 million. If they just listen to you for 5 more minutes, their mind's off in la la land. And if you don't capture the mindset of the clubber out there, you're going to lose them. You're going to make them feel overwhelmed. And so, you have to have the ability to come in and out of different teaching styles. And I think that's what every single one of us, Tyler, Tim, myself, Noah, Jim, Troy, Micah, we all understand how to do is come in and out of different teaching styles. Even though we primarily have our own unique one, we do have the ability to come in and out of different styles to make sure that we're capturing the attention of everybody instead of the one individual. That's the first thing I would say in terms of making a great teacher versus a great just a great trader. And then I think taking very advanced concepts, and I think this is what you talked about, Tyler, taking very advanced concepts and breaking them down into simple, understandable terminology and strategies that people can understand. And that's like why we do analogies. Like Tyler, you gave the analogy of the real estate owner who would just go buy a property and they wouldn't just set it there. Well, you know what? Guess what we do is cover calls. That's the teaching style through a story or an analogy that really can understand. Say, oh my goodness, now I understand it. Now I'm using the stock to do that. So I think those two things are what really creates a great teacher. And the simple reality is, guys, there's not a lot out there. I mean, if there's been anybody that's been in this industry more in different capacities than me, I have yet to find them. From the teaching to the selling to the building systems, technology, software, you name it. And I'm going to tell you, out of the entire industry, I only know a relative few who are just great traders and great teachers. And I think that's what's special about Legacy, and it's special about Tackle as well, is that we have them all.
Well, and Tyler, I got to give you a compliment here. I'll tell you, I've never once hesitated in the 10 years I've known you to recommend a student to go to your class. Not one time. And that goes to the depth of not only your teaching, but your character as well. I know that you really have a passion for people and students, and you have some, the right perspective. Where does that come from? You just naturally a good guy, or where does that come from?
I meditate.
You and Tim meditate. Well, first of all, thank you, Tim. That's very kind of you. I'm just good natured. I don't know. Well, if you ask my wife and my kids, I'm quite impatient sometimes, but that would be my character flaw, I suppose, one among many. But it's not a vitamin I take. I don't know. I think that you treat people right and you be nice, and it comes back to you. So, Tyler, I just want to tell you something. Tim he's a very complimentary young man. I set the over-under on how many compliments he was going to pay you at 5.5. He's currently at 3. Okay?
All right, but do I get to bring points back when I knock him down a little bit?
I'm just saying. I mean, we've heard that phrase 3 different times, and you've been kicked off the podcast 4 times already. Tyler, I got to compliment you. Tyler, you got to be more. You got to be a comedian. You got to laugh. You got to make people laugh. But you are the best ever.
Right.
No, so if I can interject him. So one thing I just thought of, you always hear people get interviewed and like they point back to something that happened in their childhood and this set me on the path or whatever. First of all, it's like I told Matt earlier, my memory is horrible. Like I don't remember something that happened when I was 3 and that set the course and then my personality was whatever. But one thing I do remember, I played baseball growing up and my dad was always my coach. And he had a motto, which was, whatever you are, be a good one. And so not everybody can be the pitcher, not everybody can be the shortstop or the catcher or whatever. But that was his motto. And I think that I've tried to adopt that with teaching and trading and business. And we're all in different areas in life. We wear many hats. And I think just saying yes to any opportunity that comes my way is kind of a self-motto. And so if I get the chance to do something, I grab at it and I do the best I can, and that served me pretty well. And I think just being open to opportunities and just putting your best foot forward. Everybody's heard that before, but in my personal life and experience, it's true. It's true.
I love that motto real quick. It gets people to play right field in Little League. That's a really good model.
It's important to know. You got to know how to catch.
Yep, you're not allowed to sing. We've set that standard.
Hey, by the way, Matt, I did karaoke in front of 100 people on a stage. Johnny Cash, Folsom Prison. And during the 18-point break, I actually danced.
I could see it. Did you go on one foot and do a circle?
I did the dance on the circle and jumped up and down. Did a little
I knew it. I could see it right now. You got one arm in the air, like a little bent at the elbow, the other one down. You're on one foot, hopping in a circle.
Of this.
I probably.
There is video.
Yes, you should never do that again. Ty, let's come back to the current marketplace. Right now, we're in the middle of a 6-year run in the bull run in the market. There's a lot of people out there with retirement accounts with no protection to them. Where, in your estimation, the Fed is reportedly, and in my estimation, going to start raising rates. You're at the top of the market cycle. This is the second or third most overvalued marketplace in the history of our markets, depending on how you evaluate it from a P ratio or other ways as well. The average market cycle is about 7 years total, bull and bear. Where do you see this market going? There's a lot of information that says the bull run isn't over. The bull run isn't over. Where do you see this market going into the next year?
So anytime I get a question like that, my first response is I have no idea. My second answer is the nice thing about using technical analysis and being a technician and knowing how to read charts is you don't have to know.
You don't have to care.
Because what's it matter? You can go on CNBC and have 40 people tell you what they think is going to happen, but all of them are simply guessing. They have no idea. And so we can't really escape the inherent unknowability of the future. And so I don't put a ton of weight onto predictions or forecasts, and I'll be the first to say I have no idea. Now, I am a student of history, and I do understand market cycles and average length, and all bull markets are followed by bear markets. But the thing that I always come back to is whether we go down this week and that was the end of the bull market, or whether it's 3 years from now, I have no idea. What I do know is I will be able to see it when it happens using technical analysis, looking at breaking support, breaking long-term trend lines, and I'll react when the time comes.
Let's take it a step further than that, because I love that answer, and that's the answer every technician gives. We don't care. We don't have to know. We don't care. We'll see it when it happens, because that's the beautiful thing about technical analysis. What about for people out there that are not that person, who does not understand market cycles and technical analysis and breaking trend lines and breaking support and all that jazz? What about just some average ma and pa in a retirement account who they've been working decades for? They just got hit in .com 15 years ago. They got hit in subprime 7 years ago. They're scared out of their mind right now because they don't want to get hit again. They don't understand the market cycle, but they know inherently everything goes down. What is a strategy, a very simple technique or strategy, that we could give the listeners of this podcast the ability to put into retirement accounts to protect against downward risk?
Couple things. Number one, I'll give a financial planner answer, actually, for those that just have passive accounts. The financial planner answer is you better be comfortable with your asset allocation in your portfolio. Like, if you're not comfortable seeing all your assets go down 30% or 40%, you better not have all your money in the stock market unprotected, because history tells us that happens with some regularity. Number two, the conventional answer to, hey, how do I protect myself from a bear market, is don't put money in the stock market you need next year. Your safety is in your time horizon. And so the longer your time horizon, the more confidence you can have that you'll make money in the stock market. So if you're going to do nothing, no active stuff, okay, A, be comfortable with whatever your asset allocation is. B, make sure your time horizon is correct. As to the question, kind of the answer I think you're more fishing for, active stuff, there are plenty of strategies that you can do that minimize your exposure. The one that we always introduce you to at the outset is a protective put. It's akin to buying insurance on a house. House burns down, you can use the insurance policy to basically make it whole.
Tyler,
in a similar vein...
Very quickly, let me talk on that, because that's exactly where I was fishing at. Good call on that. In terms of the protective put option, there's a lot of people out there. Like I asked my group last week, I said, guys, what's a higher probability in the next 2 years? your house burning down or your retirement burning down? What's the higher probability? And everybody's like, well, the retirement burning down, because they had just learned different market cycles and we're starting to see slowing momentum and whatnot. I said, well, does Allstate offer insurance on your retirement? They're like, no. And I said, well, how can we insure this? And I simulated, you'll probably like this, I simulated on a risk graph a $100,000 retirement account, where basically I just showed them the risk graph, how basically I allocated in the spiders, $100,000 in the spiders to simulate the retirement account, how basically I show them your risk level, you're always vertical, which means as the market goes up, you make money, as the market goes down, you lose money. What you're trying to do is adjust the risk graph to make it not vertical. And so I took a 5% of the $100,000, took $5,000. And instead of just putting it all in the spiders, I took that $5,000 and put it in December 2016 put options. Because I was also talking to them about George Soros and how he has a 22% position size that expires in December of 2016. And the risk graph, all of a sudden, it's not vertical any longer. It's vertical. It's vertical on the right-hand side, which is on the bull market side, but it basically goes horizontal right at the break-even level on your downside. And I said, guys, that's what you can do as a trader. You can't do that if you're just kind of hanging out, but very simply, you can buy insurance on your retirement account. So I want to quickly talk about exactly what the protected put option is, Tyler. And so when you're teaching people the protected put option, how do you explain this strategy to your students?
So aside from kicking it off with the whole insurance analogy, which I think resonates with everybody, I just go through an example. I say, look, if you own 100 shares of Apple at $100, you got a $10,000 position. Apple goes to zero, you lose all $10,000. And so when you buy a put option, it locks in the right to sell your stock at a set price. And so if Apple's at $100 and I buy a 90 strike put, I have the right to sell Apple at $90. And so if Apple goes to zero, I can use that put option to sell it up at 90. And so I've drastically reduced my risk. And if you want to continue the insurance analogy, you have $10 at risk, from 100 down to 90, where they don't have protection, and then the protection kicks in at 90.
Yeah.
So that $10 is kind of your deductible. And so you can control the cost of the put depending on if you want a higher or lower
take that
deductible.
Insurance analogy just one step further. We insure everything in our lives. I mean, literally, we insure our house, our vehicles, we insure our health, our lives. Tyler, I'll guarantee every one of us have insurance, maybe not Tim. I'll guarantee most everybody else except Tim has insurance on their cell phone. And they do this gladly. They literally insure every aspect of their life except their retirement accounts. They don't do that. And the retirement accounts are one of the most valuable things in a person works for, literally working decades for those retirement accounts. And to treat them so laissez-faire as they do, it's not a shock that they get beat up every 7 years. It's time for consumers to take a little bit of responsibility for their own retirement, since it is called a self-contribution model in the first place.
And no argument there. No argument there.
Well, I'm gonna play the cynic here for a minute, because every product you just named, Matt, is sold to consumers and fed down their throat. But Wall Street does not push. Well, retirements are sold, but the insurance on a cell phone, I get calls all the time. I get emails. I get this. I get that. They're selling it to me. Home insurance, auto insurance, life insurance, every other insurance is sold to us aggressively, but Wall Street doesn't sell insurance to consumers. Why?
Because they don't sell the insurance. They buy the insurance. And also take it two steps more. Number one, every other piece of insurance that we buy on our house, on our cars, on our cell phone, it expires every month. We're going to pay that 10% premium, 5 to 10% premium every single month. It expires every single month, which means you'll never get it back, regardless of if your house burns down or nothing happens to your vehicle or nothing. You just pay it. It's gone every single month. Except insurance in the marketplace, protected put options, insurance in the marketplace doesn't expire every single month. It is literally the best form of insurance that you could possibly have, because it doesn't expire every month. It expires on the date and time that you personally select. Also, on the insurance, you're not forced to have insurance. In 2013, we're in the middle of the market cycle. There's no reason to have insurance when the market's going up 30%. But this isn't 2013. It's 2015, and the market's in the red for the year so far. We're at the top end of the market cycle. People can choose when to have insurance and when not to have insurance. They can select when it expires. They can select how much to risk. They can select everything about it. It's literally the most beautiful form of insurance out there. But why doesn't Wall Street push insurance on retirement accounts? Number one, most retirement accounts are allocated in mutual funds, of which they are selling. And so why in the world would Wall Street ever say, hey, listen, you might need some insurance on this because this might go down? Because if they say that, then the consumer isn't going to buy the mutual funds, of which they're not going to get paid annual fees as well as commissions outright on the sale of that. And so if they even brought up the insurance, it hurts their ability to make money.
Well, I'm going to get Tyler's take on this, and I'm going to throw my 2 cents in. Tyler, why doesn't this product get pushed by people to consumers? Why do we have to say get out there and get educated? Why aren't they just forced to buy?
You're talking like from Wall Street. Why isn't it already built into the model that they preach protection along with investments? Well, I think it's self-interest. So if you don't look at it kind of from the bird's eye view, but you look at it from like an individual broker's perspective, I mean, I'm going to push whatever I get compensated on. And if the products that I get compensated on the most are, hey, get more assets under management, get more investments in-house, what does buying a put have to do with that?
Nothing.
Like nothing. And so self-interest drives, the behaviors of salesmen and people that push these products anyways. And so what's the upside for pitching buying puts? I mean, I don't see the upside. So if they're not compensated, why would they push it?
I agree. But then let's take it from the government angle. State of Utah tells me I have to have car insurance. Okay. The federal government has now said I have to have health insurance. Why not portfolio insurance? Got to have house insurance too, Matt. Why not portfolio insurance?
Self-interest. I think Josh said the same thing we're all saying here. I think it's all part of self-interest.
I think it's built into the system intentionally to let it crash. I think Wall Street knows that retail consumers are bag holders, and they need to have somebody holding it when they drop it back down. Traders and big institutions, in bearish markets, they don't get hurt necessarily. Goldman Sachs has been around as long as they have for a reason. And I don't think they want everybody to be insured, because then people would approach the fear and greed dynamic differently. How else are they going to inflate the balloon and then pop it? That's just, a take I have on it.
No, Tim, I don't disagree with anything you just said. Markets are inherently designed to crash. In fact, when you look at the economic model over the course of the last 30 years, from 1982 until right now, we live in what's called a neoliberal economic model, where basically money it's modified trickle-down economics is what it is. And trickle-down economics is supposed to drive, basically if you expand the business holdings and the cash flow holdings of the rich, it trickles down to the business operations of the consumers, of the populace who work for the rich. And right now, these models are not working because, number one, we outsource, and number two, Wall Street hoards. And so because of the deregulations of Wall Street, through government central banking policy, they literally create market crashes. The subprime market crash was a literal creation of basically government forcing Wall Street institutions, banking institutions, to sell houses to people who could not afford them, literally through regulations of 2001, 2002, 2003. And if financial institutions did not maintain certain credit loaning ability, they were not getting funding from the government. It was absolutely ridiculous. So, I mean, I can get all detailed in that, but at the end of the day, I agree with you.
Mm-hmm. I could play devil's advocate on that. I don't know how much more time we have, and I would like to continue this conversation, by the way.
Tyler, we'll do another podcast. Because this is a fascinating conversation.
Yeah. Well, and I'll come back. If you guys want to come back, I'll definitely come back. We'll do part two, and Tim, we can tackle those other questions.
I want to get your devil's advocate.
Well, in regards to the let's say this is the U.S. stock market being designed for crashes. So the devil's advocate would be, we're at an all-time high. Every crash we've ever experienced has been temporary. The advance has been permanent.
Yeah.
Right. And so like, is this some big end game call that there's a crash that we never recover, or are you just referring to the 4 to 5 year on average bear markets we just always experience?
No, I certainly think we're going to crash again, Tyler. But I also believe that we're going to set all-time highs again. I think that's how inflation works. I think that's how money supply works. But at some point, as they push the markets higher and higher and higher, you do not have the money supply or the liquidity to continue to drive markets that are at all-time highs. For example, if you have $1,000 buying a $10 stock, it will drive the stock a lot faster than when you have $1,000 buying a $100 stock. It won't drive the stock very fast. Same concept. When the market at the low of 2008, 2009 was about 666 in the S&P 500. Well, money at 666 will drive the market a little faster than it will at 2100. And so, you're dealing with a liquidity problem right now. It's really hard to continue to drive the market. And so what has to happen in all bubbles is you have to crash back down to an economic value where the money supply will continue to drive the market, and then you have enough time to build the market again, going higher and higher. I do believe that the markets inherently will go higher after the next crash. And I think that's going to, and there's nothing in history that I see that suggests otherwise. For me and for active traders, we just trade the cycle. And by the way, I don't blame Wall Street for that. I think Wall Street just trades the cycle. I really do. I don't think there's
the trader on the street maybe, but not Jamie Dimon, not the chair of the board of those big international banks, Matt. There's a different level there. The trader in the pit, maybe.
We're talking different things. We're talking two completely different things there, though, because when you're talking the Bank of International Settlements, when you're talking the central banks, when you're talking the Jamie Dimons of the world and the Goldman Sachs of the world, they will drive crashes just because of the positions they hold. But at the end of the day, the traders on Wall Street, the traders in general, I think the most of them are just trading the market cycle. I truly do. I don't. Well, take us for example, guys. I mean, we don't have some inherent evil in us that wants to crash all retirement accounts, but we also are going to take various positions in the bear market, right? Which means we're going to take some of those retirement accounts.
That's right. This has been fascinating. I think we got to do part 2. We're just getting started here. We did too much ass kiss in the first half hour, and I lost my internet.
We did not do too much ass kissing. Okay, you did too much ass kissing, and yes, Tyler, coming on for round 2, maybe next week or the week after.
Yeah, I should be. I think I should be good next week if we want to just do them back to back.
Hey, producer Phil, let's set it up. Part 2 next week.
Guys, I'm going to do the quick drop. Matt, you get out of here. I'll drop us out.
Thanks,
first
Tyler.
off, I want to thank Tyler for being here with us. We will do part 2 of this podcast, the Trading Justice Podcast. You can find us on iTunes. You can find us on most podcast applications, including Stitcher and TuneIn. And, one of the things about the Trading Justice Podcast that we really appreciate is if you like the podcast, go to iTunes, leave us a review, let the world know what you think about it. And make sure you give it, a good 5-star review, because the higher we rank, the more people that can hear our message and listen to what we have to say out there. This podcast was brought to you by Orbital Computers today, by the way. Orbital Computers builds high-performance computers for traders. Their systems are specifically developed with the highest quality components available to minimize latency and slippage and provide maximum processing power. They offer a lowest price guarantee on all their fully customizable computer systems. You can visit them at Orbital Computers, orbitalcomputers.com. Tyler, it's been a pleasure, my friend. Let's catch up, and we'll get into this other stuff the next time. I still got a list of questions we didn't get through, so I'll be excited to talk to you about that. You got any final words for the crew out there?
Hey, I appreciated it, man. I think this is a great format, and excited that you and Tim, or you and Matt offer this. So thanks to Phil for producing it for us.
Awesome. We'll see you next time. All right, guys, we're out. Visit us on tackletrading.com to get our latest videos, blog content, newsletters. We're going to do coaches shows over there. We're creating a community, guys, so go be a part of it. Get in the game.
You've been listening to the Trading Justice Podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, Help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.